How has AI impacted how startups raise money from investors?
AI has impacted the way startups raise money in several ways. The first is that it's easier to find potential investors. The second is, of course, AI itself is starting to create a whole different category and field for investors to be excited about. And the third is that AI itself is creating just a different velocity and pace at which people are investing.
Yeah, I've heard investors say, yeah, this company I invested in, they went from no revenue when I invested to 100 million ARR in 12 months. And you just go, how is that possible?
Yeah, exactly. So that revenue is probably being generated by a bunch of new company signups. Let's say it's in the enterprise space, or it could be developers. It depends. But let's say it's in the enterprise space. There's just so much interest and people wanting to sign up and try new things that you're seeing a huge increase in subscriber or consumption or token use by these companies, and that's generating revenue. Now, are companies getting renewals from that? Are they seeing the ability to sustain that growth? We don't know, but there's such an excitement and frenzy today to invest in those companies that are generating millions of dollars of new revenue out the gate that before wasn't considered possible until a company got to the seed or even Series A level.
Hey, business leaders and marketers, what if your brand could be featured right here? This ad spot could be yours. This channel is watched by a dedicated audience of ambitious founders, executives, and professionals who are actively looking for tools and services to help their business grow. If you want to put your brand in front of this highly dedicated audience that's difficult to reach, I'm currently looking for a few strategic partners for the channel. To learn more about sponsorship opportunities, click the link in the description. Let's grow together. Yeah, I work with startups that have a traditional mindset. Like they're working with AI, but they have a traditional mindset where maybe they had a business before that was a service-based business and now they've turned it into a software and the business is doing millions of dollars a year in revenue. Maybe they're going to raise their first round and it's a modest round of maybe 5 to 10 million because they're profitable. They don't need investor money, but they see other people raising millions of dollars. Or they had previously bootstrapped the business. They had raised a few million, they turned it into a few million ARR, they're now raising another 5 to 10 million. But the way that these companies are looking at AI and investors is much more of a traditional business mindset than like a startup business mindset, where they're like, hey, I don't know what I'm doing, I need to raise millions of dollars and then magically turn it into this unicorn in a year. So they're looking
Yeah.
at things very differently. And so I that's what excites me is, while obviously everyone wants the potential to grow really fast, these guys are going, look, I don't need this money, but if I have it, then I can grow faster. I've already got investor money, I've already got revenue and profitability, so more money means I can market faster and get more customers, but I'm already profitable on a unit economic basis. How how are you seeing investors look at it? Because I see like these guys are having a bit of a hard time raising money, even though they are great business people running interesting businesses that AI is not necessarily based on tokens, but it's essential to what they do for the services they provide.
Right. And are they raising at what you would consider a seed or a Series A?
Both. There's seed and series A, different businesses.
So we've heard the term coined this year of seed strapping, where companies might need some capital to get to a certain point, and then they could be profitable and keep going without that. Now, the key thing is, to take a step back and ask, should you raise money? Which I think is at the crux of the question, because in some cases you don't because you're profitable, or you don't because you want to maintain operational control and of course strategic direction for your company, which once you introduce outside capital starts to change. It doesn't mean that VCs are going to like kick you out tomorrow, or they're going to tell you to enter a market that you don't want to be in, but there becomes a new stakeholder at the table, and that doesn't go unnoticed in terms of like how you run the business. So chapter one of the funding framework, which is this book here. Whoops, backwards. Chapter one is, should you even raise money? Because it is possible for you to bootstrap or to be running a business with perhaps more conventional kind of growth trajectory that might not fit with the narrative that venture capitalists need to believe in, or even some angel investors, in order to create the exponential and even unreasonable growth that they should have in their portfolio in order to capture the real outliers, the real sort of winners in the startup landscape. Now, you could build a great business and you might have a lot of early traction and get to the seed stage. And in that case, say, okay, I'm good for a long time. I don't need external capital. We want to use the profits we have and reinvest that in the business and continue from there. And that's a perfectly good outcome based on your TAM, based on your competitive set, and based on the type of business that you want to absolutely run.
So one of the things that I've been trying to do is focus on family offices and people that syndicate across private individuals that are wealthy, because they have a different mindset from a VC, where if you go to a VC, the VC is going to want you to have another VC around, where a family office or ultra high net worth individuals, they'll be like, yeah, if you give me dividends, I'm also happy with that. When I was investing, I was looking for dividend-based businesses. And I've kind of seen angel investors also moving towards these businesses that are going to provide cash flow, because it's easier to get your liquidity and get your multiples and exit and leave the business, in the case that the founder wants to make you whole and kind of keep going without you. So, yeah.
And so in those cases, structuring the round and including the instrument or financing document in such a way that creates the opportunity for those downstream dividends and for someone to get liquidity is really important. And that looks different for an angel versus a family office, but they need to be able to see that. And that's going to be in ways that are very different from a VC who wants to own significant equity in your business at a point where it gets to a true liquidity event in terms of a public exit or a strategic acquisition or something like that.
Are you seeing the raise amounts or the valuations change or terms change in any way?
It's funny. I think it's like the best of times and the worst of times. For the top decile of companies, I think they're seeing astonishing valuation terms. If you are someone spinning out of OpenAI or maybe another popular company like Stripe or something like that, Palantir, like you're getting extraordinarily high valuations and good terms because people want to chase the folks that are leaving those businesses. Alternatively, I think for the vast majority of startups, valuations might be more typical to the mean. And what we're seeing overall is more capital going into fewer companies than, or the same amount of companies as last couple years. And so what this means, and the clock is still ticking on 2025, is just a belief in, a handful of companies that either have crazy growth out the gate or just astonishingly good pedigrees, for lack of a better word, in terms of where the founders have worked before.
Why do you think that's important? Like I've heard a lot of people say, "Oh, I've gone to Harvard. I graduated from Stanford, or I graduated from this place, or even I dropped out of that university. I've dropped out of like why? Why are those so important signals for investors when they're no signal for success in reality?"
So those are very important because people who people who invest in other people tend to invest in people who remind them of themselves or remind them of someone else who has been successful. So that's the short answer to the question. The longer answer to the question is, I think the incentive system in terms of like what networks, who else is investing, the sort of nature of all capital markets where there's a herding phenomenon. So if you see someone leaving a great company or a graduate of a university you recognize, they just get more points in the internal scoring system that people are using for sourcing and picking companies.
I did actually, in my research, come across a company called Alumni Ventures, and what they do is essentially create. Uh, they put together a fund where the LPs are alumni of a specific university, and the goal of the fund is to invest in people who have graduated from that university or are in that university now.
Yeah, and they are one of the most active investors in the world. I don't think you have to have graduated from one of those universities in order for that fund to invest, but they're trying to use that as a way to source and have, of course, a differentiated point of view. I think from a capital formation standpoint, LPs are attracted to the idea of like, oh, I'm supporting my school or the graduates of my school, and that makes sense. Now, Alumni Ventures has so many of these different entities or funds, and I don't know personally how they are structured, but what that allows them to do is try and run a family of small funds that would invest in these companies. Now, as for the returns, as for like, is this a good strategy versus you're just a local VC or angel who's super well connected to one of these campuses that is prolific at generating new startups? Like, we don't know yet because I don't think we can study the counterfactual, but yeah, I mean, there's definitely a a preference for things that are familiar or certain networks, and that can be by institution, that can be by location, that can be by any number of different criteria, and that's important because it allows fund managers to, particularly emerging fund managers, to stand out because they need to be differentiated as much as you and your startup and your product is.
What I noticed that was interesting about them was they like each of the funds also has its own thesis. So you may have like a Dartmouth Alumni Ventures fund, but they're only investing in a certain kind of startup, even though it's from like that university. So instead of saying we're a generalist fund for this university, it's like, oh, we're only doing biotech, or we're only doing sports medicine, or we're only doing this and that. So it's kind of weird for me that they would limit themselves within that fund. But I also noticed that they don't have my university's fund. Like they don't have a fund from the school I went to. So I was like, oh, that could be an interesting angle because I don't know if you know, but University of Florida created Gatorade.
That's right. Yeah, named after the Florida Gators. Yeah.
Surely there's an amazing medical program. There's all sorts of really great programs, even though it's not an Ivy League school. It's kind of like an Ivy League public school. I mean, at least when I went there, I'm not going to say how many years ago, long enough ago, but when I was there, it was like an amazing university that all sorts of great things were coming out of it from all the different sports and all of the different programs. The business program, the medicine program, the psych program, what have you. And I don't know what it's like today, you know, but they definitely have something good going for them.
Yeah, I think there are many universities, public and private, that have existing ecosystems around them. And those existing ecosystems are going to be successful in producing startups if they have a combination of, yes, talent, which comes from the institution, but also is there an environment where you can build a business, find customers maybe for a certain industry or something like that. Thirdly, there's angel capital, which, as you know, is the really important first ingredient. And then subsequently downstream, like capital and a way to scale and expand, maybe by porting over to a major city if you're not already in one. And so I think that's really an important sort of cocktail for how you build great ecosystems around universities, regardless of whether they're public or private.
Yeah, I could imagine like Peter Thiel, paying people $100,000 to quit university, like saying, "Hey, once you've graduated from University of Florida, you should move to Lisbon and build your startup."
And it does Lisbon like have the right like recipe for success? I think depending on the industry that you're building for, perhaps the available talent, the cost of doing business, that's an important variable too, right? It really matters. I think in the AI age, why we're seeing so many companies like come to the Bay Area, in particular where I'm based, is because of the talent density here of people who are working in and are aware of and moving in the same direction of AI transformation in business, of building in the AI infrastructure or even foundation models is just like all here. And so there is a network effect that's built out of the talent and the capital and all the other elements. So does that mean that Lisbon's going to look like San Francisco one day? No, I think Lisbon will be an extraordinary and successful place in its own right, focusing on its sort of endowments and ingredients for its own success.
Yeah, I think you're a bit more positive about Lisbon than I am for its future prospects. You know, it attracts people from all over the world for sure.
True.
And Web Summit brings investors for a week out of the year. But what I've seen is the best startups are hidden. The the local community isn't that unique or interesting. One of the problems a lot of companies that are started outside the US have is that they don't think global from day one. And so a lot of startups are thinking about their own local economy, but a lot of Portuguese I don't think have an entrepreneurial spirit because it's not really in the education system, it's not really in the societal mindset. I think a lot of countries lack that at a societal level, even if there are individuals who have it in within a given society. But I think Lisbon doesn't have the framework to support entrepreneurship. But there are a lot of entrepreneurs that live here that are foreigners.
Mm-hmm. That's true. Yeah. So I mean that is a main ingredient I think for healthy startup ecosystems is that you're welcoming of ideas and talent from around the world.
Lisbon is welcoming, but it's hard to start company. There's no incentive to start companies and build teams here with local companies. The taxation, the bureaucracy, everything is far too um, difficult, and I think Europe in general has this problem. And I think Europe is trying at the federal level to change that, but a lot of the countries, unfortunately, in the European Union also don't like the European Union taking away power from their state level,
Yeah.
which is an issue that the US doesn't exactly have because it was formed in a way where, hey, if we create a law at the federal level, you have to follow that law. If we don't have a law, you can set your own law, which makes sense. But because in the European Union, these were countries before they were part of the union, they very strongly want to hold on to their rights. And so they don't like being told what to do. They don't like being told how to spend their money or how to have their visa scheme or how to form companies. And the federal government is trying to go, "Hey, look, we have a huge opportunity. We have a ton of people that are entrepreneurs from different countries in the union, but they're all leaving for Silicon Valley because they can form companies in Delaware and raise money from people anywhere in the world because the frameworks are simple to understand, the money is easy to come by. But here in Europe, people don't have that same entrepreneurial mindset. Investors don't want to give you millions of dollars. They're much more, focused on the nitty gritty of the business. And if they're in Belgium and you're in Germany, and you have a German company, they have to then understand the German framework and they have to get their money into a German bank, and the laws may not, change, the laws may not work well. And if you all of a sudden, the investor wants you to have a Belgian company so you can serve Belgium, have Belgium employees and a Belgian bank account in Belgium, like there's just not much cross-border uh, functionality. The European Union is suffering greatly uh, due to this lack of interconnectivity. And I also see this among trains and sometimes planes as well,
Yeah.
because there's Portuguese trains and there's Spanish trains, and sometimes the tracks may not be the same width, or the wheels may not be exactly the same. And so if you want to go from Lisbon to Barcelona, you have to go from Lisbon to Madrid on on the Portuguese track, and then you have to switch to the Spanish track to go from Madrid to Barcelona. You can't take one train from Lisbon to Barcelona and stay on the track via Madrid, right? So like there's a lot of lack of interconnectivity in the union, um, which is weird to see.
You probably know about the history of why train tracks are not interoperable,
Well, because they were serving their local countries, and then
because they were used for transporting troops great miles during all of Europe's horrific wars. So, I mean, it's not just in Europe, but also in other parts of the world too. And certainly, yeah, we're living with that legacy. And you're right, Sean. Like that is something that is simple but not easy to fix in terms of making that connectivity of people, goods, ideas, talent, like even stronger.
what was really strange for me was a few years ago I was in Greece visiting a friend, and I wanted to go from Greece to Slovenia to see another friend. Well, in between Greece and Slovenia is like 4 or 5 countries that are not part of the Schengen zone. And so if you have I had a double entry Schengen visa at the time. And so when I wanted to go, you think you could just fly directly from Greece to Slovenia. Makes sense. It's only like 2 hour flight, but no. You can either fly from Greece to Serbia, which is outside the Schengen zone, and then from there back into the Schengen zone with a 90-minute layover, or you could take a bus 12 hours from Athens to Albania, and then you could switch to a boat and go up the river to Croatia. And then you could take a 2.5 hour bus through Croatia to get to Slovenia, about a 24-hour ride from Greece to Ljubljana. Why? Doesn't make sense. So I chose it was like 3 hours to Serbia. Not 3 hours. It's like an hour and a half to Serbia, then an hour and a half layover, and then another hour and a half to Slovenia. So it's like 5 hours to fly 2 flights, but I had to leave the Schengen zone to do it and fly back into the Schengen zone to do it. And originally I thought, oh, I could just take trains from Greece to Slovenia. Nope. There's no trains to go between the two.
Wow.
So that's probably why everyone's pooling in San Francisco.
Yes, there's a lot of good reasons to build here. I feel very optimistic, um, and I think San Francisco has since 1849 been a gold rush city, and that means it's a city with a history of boom and bust, like once a decade or so. So we're in the middle of another boom, and it's creating just a whole new set of opportunities, categories of companies, and I think also risks and challenges. But it's where we are in a new cycle.
Where do you think we are within that cycle? Because I've heard people screaming that the cycle's dead, that the bust it's already underway, and other people saying we're years away from seeing a bust.
Yeah, it's a great question. If I had a perfect answer, I would be putting together some elaborate investment strategy. I think there are legitimate questions, right? And so you see, as of the time of this recording, folks like HSBC saying, "Wow, OpenAI needs to raise, a couple $100 billion more, and it will still not be profitable." Or you have Michael Burry, the Big Short famous investor, saying, "Hey, there's something weird in the way that hyperscalers are, accounting for the investments that they're making." So there's lots of, like, I think, legitimate questions being asked. But when I think about the scale of the capex right now, which is probably about 400 billion a year, according to I think an estimate from Bain. We're at no question at like the biggest investment in fixed capital that we've seen since the building of the railroads around the world in the 19th century. And as a percentage of GDP in the US, I think it's slightly higher, I've read. So, what does that mean? That means we are in a cycle of building. And when you're in these cycles of building, you get to a point in the economic cycle, and I don't think we're there yet, but you do one day get to a point where there's overcapacity. And what I saw in the beginning of my career is that the overcapacity that was built in fiber created a huge wealth of opportunities because that meant that you could have cloud computing, you could have social media, you could connect people to um, to streaming services, right? And so the world we're living in was made possible by a collapse in that market and overcapacity. Now, do I think that we have to have a collapse in the AI infrastructure? No, not necessarily. But I do believe that the capacity that we have is going to create an even greater abundance of cognition and compute that is going to make a number of different businesses in different AI verticals and different AI niches possible that previously would have not been like feasible. And so what we'll see is more startups, more ideas in different verticals, changing industry, building things that make our lives better, and that is probably where it goes. So yeah, there's always, I think, good questions to ask about where we are, and if there's a lot of investment, it seems to be in the debt markets in these companies that have AAA and AA balance sheets, and that means they are investing in these data centers that will that they'll be able to fund. So you're not going to have a collapse in Microsoft one day. That's not going anywhere, nor is Amazon. So where what it means though is this multi-decade opportunity to build in and around the AI space because of what the new compute capabilities will offer.
You said AI doesn't necessarily have to collapse.
Mhm.
What would cause it to collapse?
What would cause it to collapse? So the nature of these things is usually an external event. So we live in a very tense geopolitical reality. And so I wrote a Substack post last month about three scenarios for AI. Actually, no, this was in October because I was like kind of looking at the end of the year, and so like in the next 90 days, so like what will happen? And basically, what there could be a geopolitical shock, an increase in prices of key goods, particularly like food and fuel, that can cause consumption to shift, capital markets to turn off the spigot, for interest rates to go up, right? All these things that tend to happen usually because of an exogenous event. And what we would see is therefore a decrease in funding, and that's not a collapse, but it is going from 60 miles an hour to suddenly like 10. And that feels really uncomfortable if you have to like jolt from that kind of like slowdown. And so we know we live in a world full of known possibilities and some sort of black swan events that are hard to imagine or we believe are impossible. But yeah, I expect something exogenous of a geopolitical nature, or maybe an environmental catastrophe that could change capital markets and change the abundant flow of capital into the sector.
It seems like VCs are sitting on the most amount of money they've ever had available,
Mhm.
even though they've been investing more money into a smaller number of companies, they're still sitting on the most cash they've ever had. And I mean VCs and family offices and ultra high net worth individuals.
Sure.
How do you convince them right now to give you money over somebody else?
The key ingredient is momentum. Because if momentum is there in terms of the progress you're making, I mean, you gave the example earlier of a company that right out the gate starts making millions of dollars after a few months, right? That's sort of an extreme example, but the story and the narrative of momentum is really important. And so the first part of the funding framework is storytelling. And that's a really important role for you as a leader, if you are a founder or an emerging fund manager or what have you, to capture a really powerful narrative. And you need to own that, and there needs to be that strong founder market fit and channel fit and story, and you have to be on thesis for what that investor believes in terms of where the world is moving. But storytelling combined with great organization outreach and ability to close your round with confidence are the key ingredients. And yeah, I think the momentum part of the narrative is essential.
Thanks for watching. If you liked this insight, I've handpicked another video for you right here on the screen. For more actionable strategies that get you real results, hit subscribe.